In July 2014, Banco Espírito Santo appeared stable, but hidden losses inside its own corporate group were already pushing the bank toward collapse. That exposure mattered because the bank had been lending heavily to related entities, turning internal relationships into concentrated financial risk. When Espírito Santo International missed debt payments, it revealed billions in obligations that had not been fully disclosed to investors. Those hidden debts mattered because they immediately raised doubts about the bank's capital position, triggering a rapid loss of confidence. The share price collapsed within days as markets realized the problem was not external, but embedded inside the system itself. That realization mattered because it cut off access to funding, forcing the bank into a liquidity crisis almost overnight. Depositors began withdrawing funds, accelerating pressure on a balance sheet that could no longer absorb the shock. That reaction mattered because banking stability depends on trust, and once that trust breaks, collapse becomes self-reinforcing. Within weeks, a €4.9 billion rescue became unavoidable, proving that internal risk had already made failure inevitable. In July 2014, Banco Espírito Santo disclosed unexpected losses linked to its parent group, immediately exposing financial connections that had previously remained unclear. That disclosure mattered because it revealed the bank was directly exposed to entities within its own corporate structure, increasing concentration risk. Espírito Santo International, a key holding company, failed to meet short-term debt obligations, signaling deeper financial instability. That failure mattered because it confirmed that problems were not isolated but spreading across the entire group. Investors reacted quickly, driving the share price down sharply as confidence in the bank's financial health deteriorated. That reaction mattered because falling equity value limited the bank's ability to raise capital when it was most needed. Credit ratings were downgraded, increasing borrowing costs and further tightening liquidity conditions. That pressure mattered because banks rely on continuous funding access, and once restricted, operations become difficult to sustain. What began as a disclosure quickly escalated into a system-wide concern, leading directly into how the bank's structure enabled this exposure. Banco Espírito Santo was deeply interconnected with its parent conglomerate, Espírito Santo Group, through layers of cross-holdings and internal financing arrangements. That structure mattered because it concentrated risk within related entities, reducing true diversification despite the appearance of a broad banking operation. The bank extended significant loans to companies within the group, effectively funding its own parent ecosystem instead of external borrowers. That exposure mattered because it tied the bank's stability directly to the financial health of the group, removing independence. Complex ownership chains and offshore structures obscured the full scale of these internal transactions from investors. That opacity mattered because it prevented early detection of growing financial stress within the group. Revenue streams appeared stable, but underlying risk was increasing as more capital was directed toward already leveraged entities. That imbalance mattered because it locked the bank into a cycle where new lending supported existing weaknesses rather than generating sustainable returns. By the time the structure appeared fully built, the system had already embedded the conditions that would trigger its collapse. Inside the group, Espírito Santo International had accumulated billions in short-term debt, much of it hidden through complex holding structures and off-balance sheet arrangements. That debt mattered because it was being rolled over continuously, masking a liquidity problem that required constant refinancing to survive. Financial disclosures did not fully reflect these obligations, leaving investors unaware of the true scale of risk building within the system. That lack of transparency mattered because it delayed market reaction, allowing the exposure to grow unchecked. Auditors and governance structures failed to challenge the underlying assumptions, enabling continued reporting that understated risk. That failure mattered because it removed a critical safeguard that could have forced earlier intervention. As refinancing pressures increased, the group became dependent on internal support, including funding from Banco Espírito Santo itself. That dependence mattered because it created a feedback loop where the bank's resources were used to sustain the very risk that threatened it. By the time repayment stress became visible, the hidden debt had already reached a level that could not be contained, pushing the system into escalation. As 2014 progressed, Espírito Santo International began missing debt repayments, signaling that the refinancing cycle sustaining the group had broken down. That failure mattered because it forced previously hidden liabilities into the open, directly impacting Banco Espírito Santo's balance sheet. Markets reacted immediately, with the bank's share price dropping sharply as investors reassessed the scale of internal exposure. That collapse in value mattered because it cut off access to equity funding, removing a critical path to stabilization. Credit rating agencies downgraded the bank, increasing borrowing costs and restricting access to short-term funding markets. That pressure mattered because banks depend on continuous liquidity, and once funding tightens, operations become unstable. Depositors began withdrawing funds as confidence deteriorated, accelerating the strain on already limited cash reserves. That reaction mattered because deposit outflows amplify liquidity stress, turning concern into immediate financial pressure. Within days, the combined impact of falling confidence, restricted funding, and rising withdrawals pushed the system toward a point where recovery options were rapidly disappearing. By late July 2014, losses tied to Espírito Santo Group entities had grown large enough to materially weaken Banco Espírito Santo's capital position. That deterioration mattered because regulatory capital thresholds define a bank's survival, and once breached, intervention becomes unavoidable. Attempts to isolate the bank from the failing group proved ineffective, as financial links were too deeply embedded to unwind quickly. That constraint mattered because it eliminated the possibility of a clean separation, locking the bank into the group's collapse. Funding channels began closing as counterparties reduced exposure, limiting access to short-term liquidity. That restriction mattered because banks rely on constant funding rotation, and once disrupted, solvency pressure accelerates. Internal resources were no longer sufficient to absorb mounting losses, leaving the balance sheet unable to stabilize. That imbalance mattered because it marked the transition from stress to inevitability, where collapse could no longer be prevented. At this point, the system had crossed its point of no return, setting the stage for forced resolution. In August 2014, the Bank of Portugal intervened and placed Banco Espírito Santo into resolution as losses overwhelmed its capital base. That intervention mattered because it confirmed the bank could no longer operate as a going concern under existing conditions. The institution was split into a good bank, Novo Banco, and a bad bank holding toxic assets and unresolved liabilities. That separation mattered because it allowed core operations to continue while isolating the damage for containment. A $4.9 billion rescue package was deployed to stabilize the system and protect depositors from immediate loss. That scale mattered because it highlighted how deeply internal risk had compromised the bank's financial structure. Shareholders and junior bondholders absorbed significant losses, reflecting the cost of mispriced and hidden risk. That outcome mattered because it reinforced how quickly capital can be erased when confidence collapses. What had been a functioning bank was dismantled within weeks, leading directly into accountability and systemic reform. In the aftermath, investigations focused on how internal exposures were allowed to build without full transparency or control. That scrutiny mattered because it revealed governance failures that extended across both the bank and the broader Espírito Santo Group. Senior executives faced regulatory and legal action, highlighting accountability for decisions that concentrated risk within related entities. That accountability mattered because it established consequences for using internal structures to mask financial weakness. European regulators strengthened oversight of connected party lending and group-level exposures following the collapse. Those reforms mattered because they aimed to prevent banks from embedding risk within their own corporate networks. The case exposed how complex ownership structures can obscure true financial positions until stress forces disclosure. That exposure mattered because it redefined how internal risk is evaluated within modern banking supervision. Banco Espírito Santo ultimately became a reference point for systemic failure, proving that internal risk can destroy a bank from within, even when external conditions appear stable.